makers and market movers. This is The Pulse with Francine Lacqua.
Good morning. Welcome to The Pulse. I'm Tom McKenzie in London. The AI boom has made its way to the credit market after Oracle's jumbo bond sale. That's as the software maker ramps up its spending on the technology. Let's bring in Bloomberg's Valerie Teitel. Val, how well received was this bond sale?
It was pretty decently well received. They issued a total of $18 billion. They had started with a target of 15, so it was upsized over the course of the day yesterday, and it attracted a total of $88 billion in order, so well oversubscribed. But Tom, it marks the second largest bond issuance for the investment grade credit market in the U.S. this year, second only to Mars's $26 billion deal to finance an acquisition. It was a large issuance for Oracle as they look at their funding gap and how they're going to finance generating the power and the data and the infrastructure needed for these cloud contracts. But it does start to begin questions of if now, where is all this financing going to end up? Flip the board. I want to talk about this recent study from Morgan Stanley talking about where the financing is going to be. They see the funding gap at around $1.5 trillion from now until 2008, and they see a lot of it going into the private credit market, Tom. $800 billion flowing into private credit to finance the AI boom. Another big segment is $300 billion into other private markets, such as venture capital and private equity. But this just really underscores that we're now dealing with the reality of how these AI companies are going to be funding themselves on their endeavors. And it's really shaken the equity market this week. S&P 500 futures on the week are softer, but it's looking to be the worst week now in 2 months.
OK, $800 billion potentially flowing into the credit markets on this AI spend story. Valerie Teitel, thank you very much indeed with the size and scope on that piece that we should be thinking about and how it ties into the equity market moves as well. Now, investment giants KKR and Blackstone are leading a combined $17 billion investment in the natural gas industry. It's part of a major push by private funds into a sector that's helping to quench AI firms' relentless thirst for energy. So from financing to the energy piece on AI, let's bring in opening trade anchor Kriti Gupta, who's on the ground for us in Paris at the EPIM conference with another great guest. Kriti.
Tom, thank you so much. As you said, we are live in Paris at the EPIM conference. I've got the perfect guest for you. We were just talking about KKR's monster deals. They've been very active in Europe in the last couple of years, building on top of an incredible profile. We've got the head of Europe, Philipp Freise, joining me right here in Paris. Pleasure to have you. Thank you so much for your time.
Good morning,
this morning. Good morning. Lots of energy from Philipp this morning. Europe is having a moment. Everyone is saying that. You see it in the public markets, primarily, especially from the start of the year, funds coming from around the world, arguably limiting their exposure to the States, Europe being the next big thing. Is that visible in the private markets?
Kriti, it's a great question, and it's so nice to be on. We at KKR have invested more than $20 billion across all of our businesses and $10 billion in private equity this year. That's a record year. We have never invested more. So the facts actually support what you're saying. Europe definitely is having its moment. And the reason Europe is having its moment, despite all the challenging aging society, a pension system that needs reform, low productivity growth, fragmentation, things are happening, things are changing. There's a real resolve forward to make reforms and to bring it to the future.
Some would argue that this is temporary, that this is a blip in the system, a blip in allocation, because ultimately when you look at some of the macro conditions in Europe, you named a couple of the challenges, but also the idea of the regulatory environment being not as friendly as other parts of the world. And namely here in France, we're sitting here in Paris, there's a question of that geopolitical concern, the domestic political concern, and even the concern of a potential wealth tax. Does that chill some of the optimism around Europe and France specifically?
So we at KKR have celebrated our 20th anniversary last week, actually, in Paris. We've been around the block a few times, in Europe 30 years. Political cycles come and go. What matters is really the direction of travel. It's always the direction of travel that matters, not the absolute. And Mario Draghi said it very well in his report. We do need to invest 800 billion euros a year or so. We do need to reform our capital market union, pension reforms, etc. But things are moving there. And what I'm very encouraged by, I've studied in France, I'm German, as you figured out by my accent by now, is that the France and German resolve together to bring it to the EU level and move things forward. That whenever that happens, things are moving forward in the right direction.
How much of that 800 billion euros is coming from the private markets?
Draghi pointed very much out that it cannot be done by the public sector alone. 80% or so, we would argue, of the 750, 800 billion a year will need to come from private capital. Now, we have been already a trusted partner of the industry, of companies, of families, of governments in Europe for a very long time. So the moment to bring this to bear is now, and the muscle has already been well trained. But yes, it's a lot of capital, and reforms need to happen for this to really show its results.
So our Bloomberg colleagues had reported a while back that KKR has been very active in the deal space for obviously 30 years, but more recently picked up quite a few deals in the UK, in France, in Germany as well, which is something you did during the COVID era as well, when valuations had really come down. There's an argument here that valuations aren't actually cheap right now. They're actually quite lofty. Does that chill deal making, or would you still buy in that environment and look to invest in that environment?
So at KKR, we very much believe in linear deployment. Times look frothy. We still deploy, but in limited amounts. Time look very crisis prone and nobody invests. We still deploy, and we try to deploy at the same level. So that is the point here. We just don't know what the macro will bring us. We know what we can control, and that's the micro. The companies that we invest in, how can we make them better? How can we bring them across borders? How can we put new technology in, etc.? And that is absolutely the moment to invest now in Europe, because Europe is so behind. So valuations come and go. We just deploy linearly.
Where on that spectrum are we right now? The deploy a little or deploy a lot?
Well, again, it's linear. We deploy the same amount. We are certainly not in a COVID period where it was clear that in 2020, it was time to deploy. Valuations globally, especially in the US, are high. I would argue in Germany and UK, as two examples that you put your finger on, they are relatively low still, given the potential the companies have. But again, valuation is one thing. What's more important is what we actually can do with the companies that we invest in through all the toolkit we have.
There's a big conversation in the United States right now about democratizing private equity, and they're looking to do that through 401ks, through retail investing. Now, those are parts of the financial investor base that are not as developed as Europe. Do you see that kind of seeping through the thinking here?
Well, Kriti, you're putting your finger on one of the most important topics of our time, which is that in an aging society, people need to be having comfort and trust and confidence in their retirement and in their retirement savings. And our pension system needs to wholly reform itself in terms of giving access to investments that actually produce the returns that can allow you to retire with that kind of saving pot. And therefore, our industry opening for that is extremely important. So you're right, democratizing the industry is a meta trend right now. We're at the early innings of it, but it will be a mega trend for the next 10 years for sure.
Well, it's fascinating as well, because part of the conversation around democratizing it, whether it's through pension reform in Europe or whether it's through the retail base in the United States, there is an argument out there that democratizing some of this alleviates the pressure that GPs are facing when it comes to exits. Would you agree?
Not at all. So at KKR, what we do when we offer our investments to the retail vehicles, it is just at the same level. They do exactly what the institutional vehicles do. And therefore, the cycle of investing and divesting, creating liquidity and returns is the same for the retail vehicles as it is for the institutionals. Our job is to find great company, make them better, and then ultimately sell them at great results for investors, regardless of whether that's institutional or retail investors.
Are you worried about exits at all? We've had about 3 years where people are kind of waiting for that moment for the capital markets to open up in full. Where are we on that?
So again, KKR has been around the block a few times. These cycles of, very rapid and dynamic IPO environments are often followed by times of drought. We reopened the IPO market in the UK with Trainline in 2019. We kind of reopened the IPO market at the NYSE with the IPO of Nielsen GfK recently. So IPOs are happening, and we are constructive in the next 18-24 months that things will normalize back to where they were. Of course, 21 was an aberration, and we're never going to go to those levels.
So if not IPO, then what? This is a conversation around exits right now, that if you can't rely on an equity exit, a public equity exit. Are there other ways that are becoming more popular?
Well, Kriti, we are also at a cyclical low of M&A as a percentage of GDP across the world. And that means corporates have also been quite careful. Therefore, assuming that that will normalize as well, we will have our fair share of those strategic exits. In fact, over 15 years or so, more than half of KKR's exits in Europe had always been to strategics. So I'm confident that given what we build, that will also be a very fruitful source for our exits.
All right. Thank you so much for your time.
Lots
to dig through there. Philipp Freise, the head of Europe over at KKR, walking us through the prospects in Europe, some of the concerns, how it differs from the playbook in the United States. With that, Tom, I'll hand it back to you.
Yes, some great lines from that interview. The retail piece, really fascinating. Opening trade anchor, Kriti Gupta, thank you very much indeed. More from Kriti, of course, in and throughout the show. Meanwhile, we're going to talk to Beata Javorcik, the chief economist at EBRD, about pressures on emerging European countries from the world's two biggest economies. That is next. This is Bloomberg. Welcome back. The US has formally cut tariffs on EU cars to 15%, with the lower rate backdated to the 1st of August, when the agreement between Europe and the US was reached. Bloomberg's trade czar, Brendan Murray, is here with the details. So, Brendan, good news, it seems, for the auto industry. They've been screaming and crying out for this, for their certainty as part of this original deal between the EU and the US. Are there still hurdles ahead? How significant is this?
Yeah, exactly. The European automakers were facing something like a 27.5% tariff, so the 15% looks a lot better. So they're relieved. It took about 2 months to work this out from the original deal, but there are still some issues that the European Union needs to resolve. The main one is the 50% tariff on steel and aluminum. That's still applies. The two sides are trying to get together at the ASEAN conference this week and to try to work that out. The Europeans want some sort of quota system where tariffs wouldn't be applied up to a certain quantity of steel and aluminum. So that is still a very sticky situation. The Trump administration is really going as far as it can go to protect the steel and aluminum industries. So it's going to be a tough battle for the Europeans to try to work out that part of the trade agreement. Yeah, so to your point, as one piece of the puzzle is put in place, another piece is loose, and we need to get an idea as to when that's going to be fitted in. And the same now with an update from the Trump administration that they're looking potentially at tariffs on robotics and the makers of healthcare devices. We're seeing a bit of the market impact on that. What are the details around this? Do we know the timing? What's the rationale? So these are 232 investigations. These are not the reciprocal tariffs authority that the president has used to put these blanket tariffs on most major economies, and they're more legally justifiable in the longer term. The IEEPA tariffs, the reciprocal tariffs, are under a Supreme Court challenge right now. They could be overruled, and so what the Trump administration is trying to do is to use these 232 investigations, as you mentioned, the latest ones on robotics, industrial machinery, medical gear, to try to, as a sort of belt and suspenders approach to their protectionist agenda. And so these reviews can take 270 days. This one started in early September, so we're looking at several months perhaps before the justification could come for those tariffs. But in the meantime, the American manufacturing industry is looking at this and saying, these are the tools that we use to make our goods in the U.S., robotics and the like. So it could cause extra pain for car manufacturers in particular that use a lot of robotic machinery and hospitals with the new tariffs potentially on medical equipment. OK, so we'll see if there is domestic pushback to these proposals as it works through, maybe 3 months until these are actually implemented. Brendan Murray, thank you very much indeed with the update on the trade front. 15% for European autos, that is now locked in, but uncertainty around the makers of healthcare equipment and robotics as well. Now, countries in emerging Europe, and this all ties in to the next conversation, and Turkey are facing intense competition from Chinese exports as a consequence of US tariffs, rerouting of those exports. A report from the European Bank for Reconstruction and Development finds that China is increasingly competing with countries like the Czech Republic, Hungary and Poland, all economies that rely heavily, of course, on exporting their manufactured goods.
Very pleased to say EBRD Chief Economist Beata Javorcik joins me now in the studio. Beata, thank you for your time, and we'll get into the diversions of Chinese manufactured goods into the European market and the impacts that's having. But I want to start with the news of the day and your view and your take on the significance of the settlement around 15% for the automakers of Europe when they're shipping into the US. We now have that certainty. How significant is it from your perspective?
Well, the certainty about car tariffs is a big deal. It's excellent news for Slovakia and Hungary, the two countries which in emerging Europe have been the most exposed directly to the US tariffs. This is a big industry in Slovakia, accounting for about 5% of total employment.
OK, so it's significant for those economies and those industries. And when we think about the competition that's now emerging with China, the competition has always been there, of course, but now it's stepped up a gear as some of these exports are diverted from the US market to European markets, and particularly the emerging European space that you look at. Talk us through what is happening. To what extent? What are the numbers that we're talking about? How have things changed and shifted and adjusted?
So what we draw attention to in our recent report is the growing similarity between export structure of emerging Europe, as well as Germany and France, and that of China. So China produces goods that are more sophisticated than one you would expect given its income per capita. And these goods are very similar to what emerging Europe is exporting. So in the medium term, we are going to feel more and more pressure on these countries. And this is going to be compounded by what you mentioned exactly, this redirecting of Chinese exports from the US market to other markets in the world. OK, so it's the fact that the products being produced are quite similar in terms of innovation and nature and pricing, but also the fact that there's going to be a diversionary impact as well. So it's those coupled together is significant. Exactly. How does that change your outlook for the broader economic picture for these nations particularly affected? Well, this is something that is going to play out in the medium term because emerging Europe is much more exposed to this type of competition than other emerging markets. So in a sense, if you think about emerging Europe, it's squeezed by the US tariffs and by growing competition from China. And of course, the primary force is the slowdown in Germany, which is spilling over to the European periphery. Specifically, which sectors are most vulnerable right now? Well, slowdown in Germany means that not only sectors that are part of the global value chain, so the automotive chain, are affected, but also consumer goods, so anything from food to furniture. What would you offer a policy prescription to governments in those nations when they're thinking, is tariffs a response to the diverted flow of Chinese goods? Is that something that you would recommend? What is the potential policy prescription for adjusting and mitigating some of these impacts? We have instruments that allow us to deal with dumping and unfair competitions. But of course, that's only a short-term solution. What you would want to see is more innovation, more diversification, and moving up the value ladder. And that, in a sense, brings us to the Draghi report, which was published a year ago and signaled the fact that Europe has been left behind the US in terms of competition, but China is catching up strongly. Where are you seeing evidence that policymakers are taking that seriously and implementing the necessary reforms? Are you seeing any nations and any examples where that is starting to take place? So we've heard a lot of talk about it for the past year, but now the attention seems to have shifted to defense industry. And a lot of money is being spent on defense, and that's putting pressure on government budgets. So my hope is that a big chunk of defense spending is going to be devoted to R&D. So in other words, rather than purchasing the best defense systems of today, we are going to focus on developing the best defense systems of tomorrow, and that's going to also spill over through innovation to other parts of the economy. OK, and when you speak about the spend on defence, we have to think about the fiscal space or lack of fiscal space that some of these governments have. Where is that vulnerability most acute? Which nations have more wriggle room versus others? We know that Germany has the space and they're going to be spending, but in your particular world of emerging European nations, what is the fiscal situation? Well, the levels of debt in emerging Europe are not very high by international comparisons, but what matters is the trajectory. And we see these countries planning to increase their deficits for the years to come. And one of the effects of that is that cost of debt servicing has become a very significant item in their budget. It's 4% of GDP in Hungary. It's 2% in Poland and Romania. And at the moment, these countries are borrowing at a very good rates, compared to the rates charged by the markets in France. Of French borrowing. But of course, should there be some turbulence in the markets, the cost of debt servicing will go up.
What is your expectation about defence spend beyond Germany in light of what we've seen and a ramp up of tensions just in the last few weeks with Russian jets, for example, intervening in NATO territory? It is going to put the fire under the feet of policymakers to really act on the defence piece. What is your expectation in terms of how much spend is coming down the pike beyond Germany?
Well, you see a lot of spending that has been discussed prior to the most recent events in Central Europe. So from Poland to Baltic states, countries are increasing spending even beyond their NATO commitments. What's positive is that larger share of that spending is being devoted to investment. So not just the upkeep and the army, but rather building new structures, investing in fixed assets. And that's a good thing because these countries have seen a big drop in their investment rates in general since the time of the global financial crisis.
OK, we'll see if that investment impulse has a broader impact on the economy, R&D and the innovation that you are pushing for as well in light of some of those challenges. Beata Javorcik, Chief Economist at the EBRD, the European Bank of Reconstruction and Development. Thank you very much indeed. Staying on defence, air traffic in Denmark is resuming again after large professional drones were spotted at 5 regional airports, disrupting flights and sparking a major police operation. It's the second drone attack this week. Copenhagen Airport was shut for 4 hours on Monday night in what the Prime Minister described as a serious attack on critical infrastructure. Mette Frederiksen indicating that Russia may have been behind that incident. Plenty more coming up with a focus on private equity. This is Bloomberg. Good morning. Welcome to The Pulse. I'm Tom McKenzie in London. These are your top stories. European stocks slip as Wall Street takes a breather from the AI-driven rally. Investors weigh the possibility of a bubble in the sector. Bloomberg learns Intel has approached Apple about an investment in the struggling chip maker after securing funding from Nvidia and the US government. Plus, the US sets the stage for tariffs on robotics and medical devices while lowering tariffs on EU auto imports to 15%. Now, let's get back to the world of private equity and private credit. Earlier this month, Bloomberg learned that Carlyle was working on a new fund worth more than $4 billion to help investors unlock money from their private equity investments. It's the latest expansion into the secondary PE market as traditional buyouts face slower growth. Let's get more and return to opening trade anchor Kriti Gupta at the EPEM conference in Paris. Kriti.
Tom, thank you so much. You were there just talking about Carlyle. We've got the perfect guest, hot-footing it over from the States, and joining me here in Paris is Brian Bernasek. He's the co-head of corporate private equity over at Carlyle, live with me right here in Paris. Thank you so much for your time.
Hi, thanks for having me. It's great to see you.
We're thrilled. We are absolutely thrilled. Let's talk about these capital markets here. There seems to be quite a bit of contention. Two key cohorts of people who are saying a recession's right around the corner, these capital markets aren't where they need to be. And then a cohort of people saying, well, actually, IPOs are kind of coming back. We're seeing a little bit more movement than we have in a few years. Where on that spectrum do you lie?
You know, it's a great question. And look, this is a spot where there is volatility. There is definitely complexity in this environment, in this market. But underlying the noise, what we see in our businesses is really good performance on revenue and EBITDA. We see that in the S&P 500 in the earnings numbers, and that's fundamentally very important for any economic structure and for the capital markets, clearly. And the markets are good. You know, the equity markets are up 12 or 13% this year. The debt markets are very strong. We're seeing private credit and the bank syndication lines quite strong. We're seeing spreads at really decade lows and the ability to reprice a lot of our debt for sure across the portfolio. And the IPO market has awakened and opened a bit across a number of sectors and industries. It's up 15% year over year. And the M&A market has slowly and steadily improved as well. It's up 20% year on year. So I'd say it's a bit of a healing in the market and the fundamentals in businesses and in the capital markets.
So what I'm hearing is that some of the geopolitical volatility perhaps isn't weighing on the capital markets that maybe a lot of folks 6 months ago would have said it was. Walk us through kind of the connective tissue there. Is it the fact that perhaps governments on both sides of the Atlantic are becoming a little bit more business friendly? How do you think about that?
Yeah, I think, there's definitely, that's been a piece of the volatility and the complexity, clearly. And you think back to the tariffs and Liberation Day, I mentioned the market being up 12 or 13%. It was down 12 or 13, 15% around Liberation Day. So there has been volatility in this, and there's certainly complexity with what's happening geopolitically in Ukraine and Israel, and that does weigh on sentiment and weigh on opportunities to some extent. But the key always as an investor, I believe, and we certainly believe, and I think those who perform well, whatever the asset class, they're always focused on being prepared for whatever complexity may come, having plenty of liquidity in their businesses, having a plan to drive value and change in companies regardless of the economic cycle or what may be happening around them, and having real knowledge and edges and angles in the businesses that they own. And that's certainly been our strategy. I think that's what winners can do in any environment.
Well, so one of the bull cases for both the public and the private markets has been massive fiscal spend. And you've seen that conversation in Europe. You're certainly seeing it in the United States, first under the Biden administration, now under the Trump administration as well. Carlyle is a DC-based firm. Just walk us through kind of your exposure to that world, your exposure to that fiscal spend story.
Sure. So we are headquartered in Washington. I've been with the firm for 25 years and based in Washington, and I'm not alone. A number of my partners and colleagues have similar backgrounds in Washington. We've been really of the town and have lots of networks and connectivity, which is very helpful for assessing what's really happening on the ground and what the likelihood would be of the tax bill that did get passed, of the DOGE impacts, how far along are we in those paths forward, what will happen with tariffs and will there be in a zone. And it does feel as though a lot of that is behind us from a government perspective, which also gives more optimism to us on the general overall markets. One thing that is interesting with that, though, is you're seeing significant spending on defense in the U.S., highest ever budget levels around $1 trillion. And you're seeing it in Europe, clearly, with the challenge with Ukraine and the dollars to be spent, being spent by all the NATO countries. And that's an investable trend as well, and one we expect that we'll participate in.
Walk us through the valuations on that front. If you look at the public markets, again, my favorite fun fact of the European markets is that Rheinmetall, the German defense giant, is trading at a higher public valuation. We're just looking at pure PE relative to NVIDIA. That says a lot in the public markets about where we are. When you're talking about defense valuations, where are we on that? Do they look frothy to you? Well,
they look heavy in certain areas, but there is a lot of macro trend and support and long-term growth, decades-long growth in that sector for sure. And interestingly, we sold one of our assets to Rheinmetall, so that is an avenue of asset sales for us, and we've actually been very active on the DPI front, returning $11 billion in the last 18 months in all angles, in strategics, in the case of Locke, but also in the public market, and also the financial sponsors, sort of a third across all those angles. So we've been able to tap that. I think to your question on where valuation is going to be, there's such a range of opportunities. Small businesses that are founder-owned, that are family-owned and developed and managed over time, that they are looking for partners to help them to grow. And that valuation can be much more attractive on an entry level than it might be to play in the Rheinmetall avenue. So there will be lots of opportunities, both in the U.S. and Europe, and having the connections, the resources, the capabilities, and the track record in the sector, which for us it's been 20 to 25% of where we've invested our funds, I think is a real edge and differentiator.
Well, it's interesting when you're talking about these kind of valuations where you see it. It kind of, what I'm hearing, correct me if I'm wrong, is that it's almost too good not to invest in. And that is something we've heard in the tech space previously as well. Is that right?
Well, I believe and we believe fundamentally, there are going to be great companies that have really good long-term tailwinds that there are also ones where you can drive, with great management teams, improvements on revenue, on efficiencies within the business, and that's where we're focused. So they can be long-term macro trends for sure that we want to invest behind, but independently, in the business, there really needs to be value drivers and value enhancements as well.
I want to ask you a final question when it comes to exits. We started this conversation talking about the capital markets and how they are starting to warm up.
Yes.
In the absence of capital markets warming up, or in the absence of maybe an IPO, whether there's geopolitical volatility that kind of freezes that environment, what are the exits that are on the table here if you were to face LP pressure?
Sure. Look, every deal that we do, every new investment, we're thinking about what are the multiple exit opportunities we could have in this company downrange. Certainly the public markets is one, but it's an option. Strategics have been really viable for us for many, many years, as has selling to other financial buyers. There's the entree of continuation vehicles. There can be a potential small opportunity as well. There are a number of areas to tap, and as I mentioned, we've hit a lot of those in the $11 billion that we've distributed in the last 18 months. Really tapping all avenues and really kind of equal measure.
Are you sensing any sort of nervousness from your LPs?
I'm seeing, well, in the market, it's clear that DPI is the factor. DPI is the IR, multiple money, everything rolled into one. DPI is the focus. We're hearing good things from our investors because we've been delivering. We're delivering around 20% of NAV back to our investors, which is industry leading, and we're really proud of that. A lot more to do, but we're really proud of that.
All right. Thank you so much for your time.
Thank
Always
you.
lovely to have you live here in Paris. Tom, I'm going to hand it back to you. That was, of course, Brian Bernasek over at Carlyle, the co-head of corporate private equity, walking us through some of the dynamics in the U.S. that are actually, as we were listening, very similar to what we're hearing in Europe. Some warming up around IPOs, some diversification, and certainly that defense theme hitting strong for Carlyle.
Another great conversation. Kriti Gupta on the ground for us, opening trade anchor, of course, in Paris at EPEM. And a little later, Kriti will be speaking exclusively to Anthony Tutrone, global head of alternatives at Neuberger Berman. That's just after 10 a.m. London time. Now, European new car registrations rose in August as consumers continue to warm to electric and hybrid models. The appetite for more affordable EVs has led to a 22% drop in Tesla sales on the continent, while BYD tripled its deliveries. For more, let's talk to our Europe correspondent, Oliver Crook. Ollie, break down the numbers for us. That's quite the divergence, BYD versus Tesla. But there's a lot going on here, and there seems to be, again, a bit more momentum when it comes to European car buyers and their views on hybrids and EVs.
Absolutely. There's a lot going on under the hood, and we should really break it down because there's some really fascinating numbers within this report. And I'll go just kind of the good, the bad, and the ugly within the sector in terms of the brands themselves. And you highlighted it there in the introduction. In terms of EU car sales, BYD in the month of August up 216%. SAIC, the other Chinese automaker owner of MG, up 45%. BMW, another winner. This is one of the winners within Europe, up 11%. Stellantis, below the trend, it was about 5% up overall, but Stellantis up only 2%. And Tesla down 23% in the month of August. We should say there are some interesting things within these numbers because of the base effect of last August when a lot of EV sort of subsidies expired. So last August was really a terrible number. When you look at like for like across these makers, it's very clear BYD versus Tesla. BYD obviously is coming from a much lower base, but again, I'm not sure that it's just that the Teslas are too expensive. There was another slight political story that you may also have caught that was going on with Tesla. When we look at the types of cars that were also being sold, we look at these sort of engine types, petrol versus diesel versus hybrids. Petrol was down actually in the month of August, 16%. Diesel down 18%. You look at the hybrids, up 14% in the month of August. And again, battery electric vehicles, and again, this is a little bit of the base effect, up 30% in the EU in the month of August. And I'll leave you just with one final figure here. This I found really, really interesting. Year to date, in terms of the kinds of cars that were sold into the European Union, 2.485 million were hybrids. That beats actually the number of gas cars, petrol cars that were sold into the European Union, which is only about 2 million. That is a trend that we did not see last year. That is a new sort of phenomenon within 2025. So some real motion within the automotive space that we're learning from this car sales report this month.
Yeah, and it kind of clashes, doesn't it, with all the reporting and all the announcements around the European car makers kind of walking back some of their more aggressive EV plans.
Absolutely.
So It's intriguing on that front, isn't it? And I love, Ollie, the fact that you nod to the politics. Yeah, Elon Musk, look, he's intervened in politics in Germany and France. Yeah. He's tried to do it here in the UK as well. And he's paid something of a price, and he continues to do that for that. Oliver Crook, thank you very much indeed. Important numbers and a really great breakdown in terms of what we're seeing in auto sales across Europe and particularly when it comes to hybrids and EVs, BYD versus Tesla. Meanwhile, shares in H&M are soaring after the fashion retailer's profit topped expectations. It suggests a focus on its core brand and tight cost controls are helping its turnaround take hold. The ramp-up in advertising over the past year also helped draw shoppers back into stores and online. The stock, as you can see, up 9.5%. Meanwhile, in the banking space, the Swiss financial regulator says UBS needs to do more work on its crisis plans, including in the event of a wind-down. Switzerland's biggest bank was asked by FINMA to revise its emergency planning to take account of its takeover of Credit Suisse in 2023. In a report on bank resolution, FINMA said UBS had workable plans for restructuring and resolution, but needs more room for manoeuvre if there is an acute emergency. UBS says it has an emergency plan that would be available in, quote, an extreme crisis scenario. And to technology, Bloomberg's learned that Intel has approached Apple has approached Apple about a potential investment in the struggling chip maker. They're all kind of talking to each other at the moment as part of its comeback push after the US government took a stake. Sources say the companies have also discussed closer cooperation. For more, let's bring in Matt Bloxham, tech analyst at Bloomberg Intelligence. Talk us through the rationale for this conversation. It's at early stages, we understand that, but the two parties are talking, Intel and Apple, what it could lead to, and what they're hoping to get out of this, potentially.
Yeah, so obviously these two companies have history. Apple used to source its PC processors from Intel until about the 2020s and then went in-house. I think it's very unlikely that Apple's looking to start buying chips again from Intel, but they will probably be interested in their foundry business, and this kind of comes with this broader make things in America again push by Donald Trump. And I wouldn't be surprised in the background there's some encouragement coming from the US administration for these talks to happen. So I think there could be interest there from Apple in having essentially a competitor to TSMC, which is their main provider of chips right now. Obviously, TSMC is also investing in US-based manufacturing, but I think some resilience and rivalry would be good for Apple in terms of securing supply and maybe kind of pushing to get better deals on that production. Obviously, Intel's been pushing to create a foundry business for quite some time. It's been stumbling because they haven't really had buyers come to the table to justify the investments they need to make in the production facilities. And so I think lining up people like Apple with skin in the game from an investment perspective may give them that confidence that there is going to be demand to make those investments.
And as you say, it does align, it seems, with Trump administration policy at this point. From what's happening then in terms of the chip space to what's happening in a future technology that's showing some proof points right now, and that's quantum computing. And this is HSBC telling the team here at Bloomberg, we've done the reporting on this, that they've been actually using it with real trade data at scale and have come out with some pretty significant results that they say, and one of the executives described it almost as a Sputnik moment. What have HSBC and quantum computing done that could move things forward?
Yeah, so I'd say that they used real-life trade data about bonds to see if they could get better predictive power around pricing of those bonds. And obviously, in financial markets, it's the margins that really matter, and the financial markets are no stranger to using technology to try and gain some kind of edge. So that they said that they'd gained a 34% improvement in that kind of pricing versus current technology using IBM's most advanced quantum chip. Now, my initial thought would be, is a 34% improvement enough to justify the cost of this computing power? Now, quantum's still at a very early stage. I think there's a lot of questions there about whether the economics are going to ever work out, certainly not in the near term. But I think definitely there's a lot of banks looking at quantum technology. JP Morgan, for example, recently announced something around creating truly random numbers, which could help with encryption. So I think you're going to see a lot more interest and investment into this market. And perhaps one of the interesting things is when quantum and AI collide, because quantum could really unlock unimaginable, almost kind of capabilities and performance of what we're seeing in AI today. And so that brings longer term questions for people like NVIDIA. Well, is our GPUs going to be the future of this, or at some point is quantum going to become the next kind of rival, if you like, to GPUs? I think we're 5+ years away from that at the very least, but it is an interesting kind of mid to long term kind of conundrum about where the technology is going to move next.
Yeah, and what that does to investment flows into both of those areas. Matt Bloxham, thank you very much indeed. Analyst at Bloomberg Intelligence with the context around that story. Coming up, why bonds backed by private credit loans are now among the hottest financial products on Wall Street. That is next. This is Bloomberg. Welcome back. Bonds backed by private credit loans, known as collateralized loan obligations, CLOs, are now taking up a larger part of the $1.7 trillion private credit market. So far, about $30 billion of private credit CLOs have been sold this year, and issuance is expected to hit an all-time high of $50 billion by the year end. Joining us now is Angie Long, CIO at Palmer Square Capital Management, one of the largest global CLO issuers with $36 billion in AUM. Angie, let's start with the broader picture then in terms of the demand and the issuance, and then we'll get to what you're doing in Europe, because that's really fascinating as well. Good morning. Thank you for joining us around the set.
Thank you for having me.
So we're expecting to get to kind of record levels. What is driving this at this point?
I think there's tremendous demand from investors for products with yield. And it's been a very strong year for issuance, both in the US and in Europe.
What is the global rate environment doing to that? And globally, I mean, we'll look at the Fed, rates coming down. We're not sure exactly where the neutral rate will land. The ECB's at 2%. Here, the BOE's at 4%. But rates are gradually, in most of those jurisdictions, if you strip out Japan, moving lower. What is that doing to the broader demand picture in that search for yield?
I think it means you need to go to alternative places to look for yield. And what's interesting about the CLO market is it's a tremendous pickup also from corporates and other areas of more traditional credit. So you're getting a pickup from the rates environment, but also from other areas of credit.
What are the benefits for issuers?
Well, I mean, for issuers, it's it is a tremendous way to finance new business growth and acquisitions. And it is. The leveraged loan market is the largest credit market in the world. And
you have launched a CLO ETF in Europe now, collateralized loan obligation ETF.
We have the first passive
the
CLO.
First passive CLO in Europe.
That's right.
Why now? And what is the demand looking like for that product?
The demand has been incredibly strong. What's interesting is that of the CLOs that are in existence, only 0.25% are in the ETF market. So we still see huge room for growth, but there's been several issuance this year. I think there's 16 CLOs that exist 16 CLO ETFs that exist right now.
And this is the first passive CLO ETF?
This is the first passive one.
Do you have more in the pipeline then?
We do.
In what kind of time frame? What do they look like? How they differ?
I mean, a lot of our income products are tremendously strong, so this will be more, we can do more of an actively managed one. We can do ETFs that are not just for the senior part of the capital structure, but more the mezzanine part.
Why start with passive versus active?
We have an index that has been in existence for almost 8 years with tremendous performance. So it's tracking an index that's done really well.
Okay. In terms of regulatory structure means that these are institutional investors that get exposure to this passive CLO ETF for now. What are you hearing in terms of whether or not regulators start to think about changing the goalposts so that retail investors can get exposure?
The CLO market has been one that has generated steady, strong income for a long time, and it seems to me that that's a product that a lot of retail investors would and should be able to access.
And are you hearing? Do you have conversations with regulators in Europe? Are you hearing anything with your?
Yes, but I'm not sure that I'm on the most inside track of anyone for sure.
Okay, but you think it may be heading in that direction?
I think it makes sense too.
Okay, so retail investors can watch this space as well. Look, you also have a broader feel in terms of the credit markets right now, and you look at the spreads. I mean, when you look at US corporate credit, spreads are very, very tight.
They are.
You can put it into historical context for me, but it's looking tight. Is it looking? Evaluations looking a little too rich for you?
I think it means you've got to pick your spots. For us, we tend to be up in quality, and the good news is, especially in the CLO market, even a really defensive posturing can give you a tremendous pickup in yield vis-a-vis corporate credit, more traditional bonds. And so I think you've got to be careful in the companies that you are picking. Spreads are tight, but CLOs offer a space for yield pickup.
Okay. Do you have a particular region? I mean, in Europe, is there anything that's kind of screaming by at this point? Anything you're avoiding? Anything you're looking at? Where are the opportunities in credit in Europe?
In general, up in quality.
Up in quality.
Steady companies that can be resistant to any sort of economic pullback, resistant to inflationary trends.
We've seen, going back to the ETF piece of this as well, so we've gone a little macro, now we're going back to the product itself. We've seen some examples, an increasing number of examples of mutual funds being converted into ETFs.
Yep.
Does that continue? What is behind that trend?
I do think that continues. It's a global trend that we're seeing. I mean, it is, from a fee perspective, it's a friendly move for investors, and I think there's a lot of investors that appreciate the liquidity, intraday liquidity that can happen and transparency in the ETF market.
And do you see that as a driver for CLO ETFs?
For sure. I think across the spectrum of ETFs, credit is a space where people really want to be right now. And again, CLOs offer the most compelling yield that you can get within the credit market.
Okay. Angie Long, thank you very much indeed. Really interesting in terms of developments when it comes to collateralized loan obligation ETFs, their prospects here. Institutional investors, maybe things change for retail investors in the future. Angie Long, CIO at Palmer Square Capital Management. Thank you. Now, we're going to be speaking to the SNB, the Swiss National Bank president, of course, Martin Schlegel, a little later. They kept rates on hold at 0%. There was some excitement, trepidation that maybe they would move into negative territory. They did set the bar very high in terms of wanting to do that. They're pretty reluctant to do that, and they didn't. They held rates, but we're going to be speaking to the head of the SNB. Views, of course, on the tariff impact, 39% still on Swiss exports to the US market. The currency, of course, and strength that we've seen there. All those questions will be put to the head of the Swiss National Bank, having kept interest rates on hold after 6 consecutive cuts. And the new Fed Governor, Stephen Myron, will be on Bloomberg surveillance at 1 p.m. London time. He's called for multiple 50 basis point cuts from the Federal Reserve. That will be a fascinating conversation, so certainly stay tuned for that interview. Stephen Myron, of course, with our US colleagues. Let's check in briefly on the markets in Europe. A little bit of a soft picture right now across the benchmark, down 0.4%. You do have concern about some of the makers of healthcare equipment, given the Trump administration threats to additional tariffs there. Here in the UK, the FTSE 100 is down 0.2%. The DAX is off 0.5%. US futures right now, range bound. We've got more data, jobless claims, and then PCE, the inflation gauge, which we know is spotlighted by the Fed. That comes up tomorrow. That is the picture right now. US markets, it seems, looking for direction. Stay with us. The brief is next. This is Bloomberg.